Today we're going to talk about zero DTE options. They have boomed. Is this a bubble? Is it going to go bust? What does it mean for markets going forward now that people are trading such short-term expiration options? We're going to explore all that, but first, make sure you hit that subscribe button. We want you to get as much education, as much know-how as possible, and we're always putting out new educational videos to make you a little bit smarter on how to manage your money, how to trade in the financial markets, and how to succeed. Hit that notification bell to be notified whenever videos are coming out. So let's get to zero DTEs. What is a zero DTE? Well, the DTE stands for Days To Expiration. So there's 0 days until they expire. They are same day. It's sort of like a day trader. A day trader will say, I'm going to buy this stock, I'm going to sell it an hour later. That's a day trade if it happens within the same day. Well, zero DTEs, a lot of times there's no exit because they expire at the end of the day. So if we sell a zero DTE and it finishes out of the money, we can let it expire and we profit the credit brought in. If we buy a zero DTE, we can sell it off before the market closes, or if it's in the money, it will exercise and turn into stock. If we're trading an index option like the SPX, well, then it's cash settled. There is no stock delivered. Those settle in cash. So it depends on the asset you're trading. This is part of why SPX index options are so popular, because they're European style. They settle in cash. There's no stock delivery. Whereas if you were trading SPY and it settled in the money, there would be actual shares delivered to your account. And most option traders are not trading options with the goal of having this big stock investment come into their account from the option. They're trading the option for no debt leverage. They want to leverage that big investment with a smaller amount of capital. So usually if the trade works, doesn't work, whatever, we will exit the position or let it expire. We're not converting. We're not allowing our options to exercise in most zero DTE expiration example trades. Now, if you trade a zero DTE, what you're really doing is speeding up the time frame, speeding up the process. We know that theta, time decay in an option, is most rapid the closer and closer you get to expiration. So theoretically, this would be very good for the option seller. They say, well, I'm going to sell this very short term, this option that only has a few hours left, and all that theta will decay, it'll finish out of the money, and I'll be golden, right? Sounds good. Well, I used to trade something sort of similar to this. Back in the day, I'm talking many years ago, we didn't have expiration. We didn't even have weeklies. We only had monthly options, and a monthly option expires the third Friday of the month. So that's your standard. That's the one that's been around forever, our third Friday expiration options. After that, they created weeklies, which are every week, every Friday, some stocks will have an expiring option. So nowadays, if you're trading Apple, Amazon, SPY, SPX, whatever, there will be an expiration every single Friday. You can trade them. They'll always make sure that the front 6 weeks are covered, that you have an expiration for the next 6 weeks. Even if there's not a monthly there, they'll stick a weekly in there. Now, with the popularity of options, what's happened is they've increased expiration. So now SPY, SPX, these types of options have expiring daily options. You'll have a Monday, you'll have a Tuesday, you'll have a Wednesday expiration. That allows for this zero DTE type of trade because there's literally an expiration every single day in the major market assets. I used to trade a program. It was called the 7-Minute Trader. The idea here was that it only takes about 7 minutes to place a trade. You know, find the trade, you log into your broker, you put in the strike prices, you put in the price details. I could do it faster than 7 minutes, but in 7 minutes, I could find and execute a trade in these assets. And so I used to trade this where I would sell short-term options, and it worked like clockwork. It was very successful. Now, I wasn't doing it every single day because we didn't even have expirations that were every day, but I was using weeklies. So maybe on a Tuesday, I would sell options that would expire on Friday, and I was using credit spreads. Limited risk. If the trade blew up in my face, I had a limit to how much I could lose. I also had a limit to how much I could make, just the credit received. But if most of them panned out and I was able to manage the risk on the losers and hedge off some risk and reduce my max losses and so forth, it was very successful. I started to find, though, that the popularity of these short-term option selling strategies made it less attractive. It used to be a huge advantage. I had a big margin of safety. I was very successful for a lot of time. And then it got to be kind of mediocre. Why did it shift? Well, it's about popularity. Once everyone caught on that some of us professional traders were doing so well selling short-term options, more people came in and more people came in. And the more people came in to sell those short-term options, it changes pricing. When there's a lot of sellers for something, where does the price go? The price goes down. So for the same trade that I used to be able to put on, I could still put it on, but I would collect less credit. I continually saw an erosion in how much I could collect for this credit spread. Now, was there still an ability to make money? Perhaps, with some knowledge, some expertise, knowing how to delta hedge, et cetera, et cetera. But the point I'm making is that the prices shifted dramatically because so many sellers came in doing the same thing. And when you have a ton of sellers, it shifts the prices. Think about an example would be over-under on a football game. In Vegas, they set a line. They say, okay, the New England Patriots are playing the Denver Broncos. They're expected to score 45 total points combined, right? If they look at that and they run models and they run all their analytics, they say 45 is the right number. But if a lot of buyers come in, if everybody starts betting that it's going to be, such and such a number, it will leave Vegas exposed. It will leave the casino because the casino just wants an equal number of buyers and sellers. They want to be the middleman and make the spread, right? They don't want to be left with risk. Sometimes they will be left with risk if everyone piles onto one side. Or imagine everyone started to bet the under and they were just overwhelmingly betting the under. Well, they'd be exposed to that. They would have perhaps millions of dollars at risk. A lot of times in a Super Bowl, they won't be able to match up an equal amount of buyers and sellers. They shift the line, the betting line, to try to do that, but they'll leave themselves exposed on some big event like the Super Bowl to the tune of millions of dollars. Well, they don't want that. They just want the free money. They just want to be a market maker and make the little spread that is zero risk to them, right? Find a buyer, find a seller, make the little spread, and they made a small amount of money, but do that thousands and thousands of times, and it's very, very profitable. So that's how basically option prices work. If everyone's coming in, selling, it drives the premiums down to a point where perhaps the premiums are not worth the risks that are being taken. And it certainly, at least, let me say at minimum, reduced the ability of what we used to be able to do. How good the opportunity was before, it's not that good today, period. Now, can it still be good? Yes, because again, if you know what you're doing, you know how to take advantage of the opportunities, you know how to hedge and do the risk management and all the things that we teach at the Cashflow Academy and our 4 pillars. If you know how to do that, well, there's some opportunities in anything that you trade. But the zero DTE opportunities that we had from an option selling standpoint are not there. Now, someone might say, well, on the flip side, if so many people are selling zero DTE types of strategies, would that create an opportunity where the prices get too low and there might be a short-term buying opportunity? And I think there is some truth to that in periods of volatility. So when there are, let's say, VIX spikes above, let me at least say a 25 VIX. When the VIX, the fear index, gets above 25, now it could be intriguing to go and look at some short-term option buying in a depressed market, because you have all those option sellers that are just thinking that they can sell options. That's where they really get run over, is in those bursts of volatility. So that would be my area of focus. Again, only during specific times. This recent example where tariffs knocked the market down, the VIX exploded to the upside, would be a prime example where buying some of those short-term options could have been an absolute payday. And there are some zero DTE type of strategies that could have really taken advantage of that. But make a long story short, you need to know the things that we're talking about, how theta applies to the options market, what gamma risks there are, how to delta hedge, all the things that we teach in the Cashflow Academy curriculum. So join us for more information. Make sure you hit that subscribe button. This is a little more information on the zero DTEs and how people are utilizing them. Hope you found it helpful. We'll see you next time.